All right, let's just jump right into this explainer. Look, if you've ever read a business blog and felt completely overwhelmed by the absolute alphabet soup of jargon, CAC, LTV, MRR, EBITDA, and thought to yourself, man, do I need an advanced finance degree just to understand this? Well, you are absolutely not alone. Today, we're going to take that dense list of business terminology and transform it into a super digestible, scenario-driven operator's playbook. We aren't just going to sit here and define words like a textbook. We're going to look at the exact target benchmarks and optimal business conditions for each metric so you know precisely what a flawless, healthy company actually looks like under the hood. To make sense of all these terms, we're going to treat your business like a machine, an operator's engine. We'll walk through 4 key stages: fueling acquisition, unit economics, scaling strategy, and finally, valuation and exit. Okay, section 1, fueling the acquisition engine. This is where we bring people into the machine using funnels and buyer psychology. A sales funnel basically filters your audience, right? It takes them from the top of funnel, or TOFU, down through the middle, and finally down to the bottom of funnel, the BOFU. The absolute ideal scenario here is perfectly matching your action to the customer's exact mindset. At the very top, they're just in the awareness stage. So your target operator action, give them a lead magnet. Think of a highly valuable, completely free PDF or template that you give away just in exchange for an email address. Then, as they move down to the bottom of the funnel into the conversion stage, the gold standard is offering a tripwire. This is usually a massive value, super low-cost offer, like a $7 mini course designed specifically to effortlessly flip a casual lead into a committed paying buyer. Now, as a customer journeys through that funnel, a perfectly optimized business is tracking every single step. During the awareness phase, you're watching your click-through rate, or CTR, and your cost per click, CPC. Moving into acquisition, you're heavily monitoring your CPA, cost per acquisition, and your CPL, cost per lead, so you know exactly what it costs to get them in the door. When it comes to conversion, a flawless setup means having a high conversion rate and really rapid sales velocity. That literally just means deals are moving through your pipeline incredibly fast, they aren't stalling out. And finally, advocacy. Here you want a high net promoter score, or NPS. Basically, your customers love you so much they're out there doing your marketing for you by telling all their friends. To really maximize that conversion rate we just talked about, the ultimate business condition is creating what Alex Hormozy famously calls a grand slam offer. Look, this isn't just slapping a 20% discount on a product. It's building an irresistible offer structure that balances the value equation. You want to maximize the dream outcome for the customer while minimizing their perceived effort and the time it takes to get there. You achieve this state by utilizing risk reversal. Think of Domino's classic 30 minutes or its free guarantee. It just completely removes any buyer hesitation. Combine that with injecting genuine scarcity and urgency, and you practically force immediate action from the buyer. Moving on to section 2, unit economics and profitability. Once the funnel is fueled, it's time to pop the hood and check the engine's actual efficiency. This brings us to what is honestly the absolute holy grail of business metrics, the LTV to CAC ratio. This measures the efficiency of your acquisition by comparing the lifetime value, so the total revenue you expect from a customer over their entire relationship with you, against the customer acquisition cost. Your CAC is the total cost to acquire them, and that includes all your ads, your sales tools, your team salaries, the whole shebang. For example, if it costs you $100 to acquire a customer, but they only ever spend $50 with you, well, your engine is fundamentally broken. Strong businesses ensure their expected lifetime value vastly outweighs that upfront acquisition cost. And your North Star metric for this efficiency is a 3-to-1 ratio. That is the ideal business condition you are striving for. 3-to-1, or even higher. It means for every single dollar you spend acquiring a customer, you're making $3 back over the course of their lifetime. If your ratio is sitting at 1-to-1, your engine is stalling out and you're just trading dollars. But if it's 5-to-1, you've built an incredibly efficient, highly profitable machine. Digging a little deeper into that efficiency, a really healthy scenario on the marketing front looks like a 4-by return on ad spend, or ROAS. That's $4 back in revenue for every $1 you drop on ads. You also want a super short payback period, which is simply the time it takes to recover your initial acquisition cost. And, of course, the absolute dream scenario for an operator is seeing steadily increasing average order values, or AOV, meaning people are buying more stuff at checkout, alongside rising average revenue per user, RPU. The more each individual user spends, the healthier the engine. Think of recurring revenue models kind of like a wooden bucket. An unhealthy condition is a leaky bucket. If you have a high churn rate, meaning a huge chunk of customers are canceling their subscriptions every single month. It completely ruins your monthly and annual recurring revenue. The water just keeps pouring right out. The optimal setup is high retention rates. When customers actually stay, the bucket fills up, and that allows for highly profitable expansion revenue. This means you're making extra money from existing customers through upsells and premium upgrades, which is infinitely cheaper than constantly trying to hunt down new ones. To survive and maintain that healthy state, you have to meticulously track your margins. You deduct your cost of goods sold, the COGS, to find your gross margin. Then you factor in variable costs to find your contribution margin, which is absolutely vital for making smart scaling decisions. Ultimately, you're looking for a nice, thick net profit margin. But listen, survival also requires keeping a strictly paranoid eye on your burn rate, how fast you spend cash every month. Actually, ask any founder, and they'll tell you this is the metric that causes sleepless nights. You have to ensure you maintain plenty of runway, which is the amount of time you can operate before the bank account hits absolute zero. The ultimate goal? Build an engine that generates so much cash that runway isn't even a word in your vocabulary anymore. All right, Section 3, Scaling Strategy and Operations. Now that the engine is profitable, it's time to scale it up by analyzing market conditions and tightening our internal systems. When looking at the market, a lot of founders get completely blinded by the TAM, the total addressable market. It's usually this massive, exciting number. Say you sell premium dog food. Your TAM might technically be every single pet owner on Earth. That's a fun number for pitch decks, for sure, but a seasoned operator knows it's not realistic. You have to focus down to the SAM, the portion you can target, and more importantly, the SOM, the serviceable obtainable market. That is the realistic slice of buyers you can actually capture today with your current team and your current ad budget. And you can only capture that slice of the market when you hit PMF, product market fit. This is that magical, kind of chaotic business condition where demand strongly matches what you're offering and the product is just flying off the shelves faster than you can build it. You achieve this perfect alignment when your unique selling proposition, what exactly makes you different, and your unique value proposition, why the customer should actually care, perfectly intersect with the market's deepest pain points. To handle the massive growth that comes from hitting product market fit, your internal operations have to be flawless. Under ideal scaling conditions, your team doesn't guess what to do. They follow strict SOPs, the standard rule books of your company. You measure their output via KPIs and set ambitious company-wide targets using the OKR framework. The entire goal here is leverage, getting the maximum output per unit of time, money, or people. And critically, every single one of these actions must align toward one North Star metric. The single metric at best reflects the core value your company delivers to the world. If you happen to be running an app or a digital platform, scaling requires looking really closely at user engagement. You'll track your DAU, daily active users, and your MAU, monthly active users, but the true target benchmark you're optimizing for is a high stickiness ratio. You find this simply by dividing your daily active users by your monthly active users. A high percentage here reveals incredible habit strength. It means your app isn't just sitting on their phone gathering digital dust, they are absolutely addicted to opening it and using it every single day. Finally, Section 4, Valuation and Ultimate Exit. What is the true worth of this finely tuned machine when it's time to talk to investors or plan a lucrative exit? The second you sit across from investors, the vocabulary completely shifts. They are going to judge your operational profitability primarily through EBITDA, earnings before interest, taxes, depreciation, and amortization. A healthy, growing EBITDA directly drives up your overall valuation, which is what the company is theoretically worth on the open market. During this phase, the optimal scenario for you as a founder is to fiercely protect your equity by closely managing the cap table. You want to make absolutely sure that bringing in new investor money doesn't slice your own piece of the pie into crumbs. You've got to avoid excessive dilution. If you're in the software space, the absolute gold standard that investors drool over is hitting the Rule of 40. This is a benchmark where your growth percentage plus your profit percentage equals 40 or more. So for example, if you're growing at 30% year over year and you have a 10% profit margin, boom, you hit the rule. It proves that you have perfectly balanced, explosive, rapid growth with actual sustainable net profit. It's the ultimate indicator of a flawless software engine. Ultimately, I want to leave you with this final provocative thought. Think about all these metrics we just covered, from your LTV to CAC ratio to your conversion rates to your EBITDA. Do they all connect into a flywheel? Because a flywheel is the absolute pinnacle business condition. It's a growth loop where every time you acquire a customer, their success and their revenue directly fuel the acquisition of the next customer, compounding your momentum exponentially over time. So ask yourself today, is your engine struggling to turn? Or are your metrics working perfectly together, building an unstoppable flywheel?